need to, how do I move these on now? I can't see. Oh, here we go. Okay, all right, I've got that. Okay, all right. Well, I can go now, whenever you want me to start.
Yeah, you can go. Good luck.
Okay, thanks. Hello, and thank you for the opportunity to talk to you today. I'm going to provide you with Drewry's outlook for the container shipping market, looking in particular at the impact of COVID-19 on its prospects. And also, I'm going to talk a bit about Drewry's forwarder benchmarking club and how that can help you support your business. So my starting point for this will then be to look at firstly the outlook for the trade and cargo demand, and obviously that's where the COVID-19 pandemic has had quite a big impact. But also, actually, in terms of capacity deployment, indirectly, it's had a significant impact. And then on the utilization rates that the carriers have managed to achieve through their various coping mechanisms. I'll then look at the issue of equipment availability, which is another important part of the supply side and has been an issue of late. And then I'll look at what all this means then for the outlook for container shipping rates, before I then give you a bit of information about Drewry's forwarder benchmarking club and how that can help your business. So let's firstly look at the outlook then for the container shipping trade. Firstly, this chart then is showing you the percentage change that we're forecasting for this year in global container port throughput, and then for each of the different regions around the world. And so the total for the world port throughput is shown in the bottom right-hand side of the chart there. And you can see that currently we're projecting that the port throughput will fall this year by around 3.3%. This is our central scenario projection. More on our scenarios in a minute. And so the second quarter represented very much the trough in the market. As we all know, that was when there was the lockdown was most, due to COVID-19, was most evident, particularly across Europe, but also earlier in that quarter and earlier in the first quarter in parts of Asia as well. So since the start of the second half, we've seen a gradual, but actually quite surprisingly sprightly recovery in trade right through to the present day. So the quarter-on-quarter, the annualized change by quarter still remains in relative negative territory. We expect that to be the case for a bit into the early part of next year, but nonetheless, the recovery has been very strong indeed. Now, we think there are two reasons why the recovery has actually been stronger than we'd originally anticipated, because the contraction we're forecasting for trade this year is actually much lower than the contraction we thought was likely to arise when we looked at the forecast earlier in the year. I think earlier in the year, we were looking at a contraction of around 7% back then. So a much lesser contraction projected now. So two key reasons for this. One is that Western consumer spending has ended up being higher than anticipated due to what we term involuntary savings. That is savings that individuals have made through restrictions to their commuting habits, to not taking any holidays, not spending money on entertainment, and also less spending on fuel for driving cars, etc. And of course, those savings have then been spent on other e-commerce activities or products bought over the internet. The other thing has been a significant driver of cargo demand has been restocking of inventory, and also the fast forwarding of some orders due to concerns about a second wave outbreak of COVID-19 that could impact availability then of particular products and commodities, and that particularly swelled third quarter demand. If I come back to the chart, then you can see, looking at the different regions, there's quite a lot of variation in terms of projected growth rates there, but nearly all of them are in negative territory. I think the Middle East is the only one that is not. So where regions are close to the neutral line or perhaps above it, like the Middle East, that's really because they're either coming off a very poor 2019 growth pattern, or because they've been much less impacted by COVID-19 itself or a combination then of the two. If we then look now at the different scenarios then for the projection of global port throughput, the brown line there shows you Drewry's central projection. That's our baseline projection for port throughput growth over the course of the next year. And there's two dotted lines there. The upper one is the upper scenario. That's the more optimistic scenario that COVID-19 will be brought under greater control through the course of the first part of 2021. And therefore we'd see faster economic growth as a result of that. And there's a downside scenario where COVID-19 pandemic second wave has a much more severe negative impact on trade development. And then we see, therefore, a lower rate of growth there. So our central projection is that whilst there is a second wave taking place in terms of COVID-19 outbreak, particularly now across Europe, as many of us are seeing, that the overall impact on economic output and trade demand shouldn't be as significant as we saw earlier, and therefore shouldn't dent too much the outlook for growth. Therefore, we're projecting then that next year there would be a 6.6% rebound in growth of port throughput next year. So if this transpires, it will bring port handling back to the same level as we saw in 2019. And our long-term projection over the next 5 years then on this scenario would be a growth rate of around 3.6% a year over the next few years. We'd also expect to see some normalization over that period in terms of capacity development and also freight rate development. More on that a bit later, because obviously that's been highly volatile of late. However, what we'll come on to later on is that despite this growth projection that we're talking about, the industry will remain heavily with overcapacity, that which will reduce a bit, but we're still going to end the 5-year period with continued latent overcapacity. Now, the downside risk, though, is increasing as we see from the news of more lockdown provisions taking place across Europe as the concern over COVID-19 spread rises. And so under this downside scenario, if this second outbreak of the infection does lead to significant negative impact on economic output in those affected areas, we will see a very different scenario for port throughput projection over the next year. So we're therefore under this more pessimistic scenario, recovery will be limited in growth next year to just 2%. So that's a difference from 6.6% I mentioned to just 2% growth rate. Now, it's unclear as to which of these two scenarios may play out. I think that what is true is that when we did these forecasts, that was at the end of September. We're now a month on from there, and it could be that the outlook could be for a slightly lower level of growth next year than we're projecting from our central scenario, but perhaps not quite as bad as the most pessimistic projection there. And I think that some of the issues, in addition to this worsening outbreak of COVID-19 that may impact growth, is also another potential negative, is that many state support programs have been extended through into the Northern Hemisphere winter months. But once governments start to unwind these schemes, unemployment could rise very steeply. That will reduce household disposable income and dampen consumer purchasing and therefore cargo demand. So a lot to think about then in terms of how these forecasts may play out then over the next few years. Okay, so now let's look at the capacity side now. And I'm showing you here the percentage change in world port throughput, which is following that blue line, and then I'm comparing that then with the development of the global container shipping fleet measured in TEU, but shown here in percentage terms, and that's shown then by that brown line there. And you can see then for 2020 how this gap of growth rates between the two has diverged significantly. So we've seen global port handling, we reckon, contract by 3.3%, and yet fleet growth we're showing here as growing by around 3%. So there's a gap, there's a almost 6.5% gap between the two, obviously adding then to this sort of excess capacity that we're seeing today. So at the moment, there is a capacity of around 23 million TEU in the fleet. And as I said, by the end of the year, the fleet would have grown by about 3%. What's extraordinary really is the way that the carriers have managed to control capacity so tightly and far better than they have done in any previous crises. And therefore, they've been able to secure very strong load factors and huge increases in rates. And I'll come on to that a bit more in a minute. And also they've done so at a time actually when costs have been relatively low. Certainly bunker costs have been relatively low as a result of the decline in demand for fuel generally. Many carriers now claim that they've learned the lessons of the past through this COVID-19 crisis, and how to better manage their business, and particularly capacity in very volatile demand scenarios. Now, this could have quite long-term repercussions then, we think, for carrier resilience and profitability, but also obviously for freight rate projections over the next few years in a industry which has been dominated by cyclical variations and the boom and bust dynamics of the business. I think also looking on the supply side is that to some extent this excess capacity that I'm referring to, because of this big gap in the growth rates of both capacity and demand, as you can see from looking at this chart, has to some extent played to the benefit of the carriers insofar as it has enabled them to cater for very high volatile upswing in demand when it appeared of late. And the speed then with which ships have shifted from being redundant to essential has been really quite staggering, as evidenced by the rapidly shrinking idle fleet and soaring charter rates. So with ships now back in demand, we think that deliveries are now expected to be more in line with the early year schedules, in other words, the anticipated delivery rates that were published at the beginning of the year, and therefore unlikely to see these orders pushed or these deliveries pushed back into future years, as we had previously thought may happen. In terms of the fleet capacity growth over the next few years, next year we're anticipating growth rate falling to just over 2%. And we think that if you look at the chart then that the projection for growth in the fleet will remain pretty low then over the forecast period. And therefore cargo demand under this central projection is forecast to grow at a faster rate than the fleet, which will obviously reduce the level of latent overcapacity, but it won't eliminate this overcapacity that we have across the fleets at the moment. And of course, this very low appetite for new builds is being driven by a number of factors, notwithstanding the uncertainty over trade development and obviously this COVID-19 situation, but also there's big uncertainty over the regulations regarding propulsion systems and fuel systems, which is hesitating investment in new vessels. This chart then is then tracking the blank sailings on the main trade lanes around the world, and so and it's tracking it on a weekly basis. And of course, this has been a major tool that the carriers have used then to manage capacity over the course of this year. In fact, earlier in the year, then the idle fleet actually reached as much as 10%, which is the same percentage withdrawal of the fleet that we saw during the last big recession of 2009. And although actually in TEU terms, the idle fleet was actually much bigger because the fleet itself has grown significantly over the last 10 years. And in terms of the number of blank sailings on east-west trades, blank voyages were up at almost 400% in the second quarter compared with a year earlier. On some trades, as much as 30% of scheduled sailings were blanked, particularly then in April. And of course, if you look now, looking at this chart, you can see the number of blank sailings has fallen quite dramatically. So that last month, for example, they were represented just 3% of total sailings. So this remarkable capacity discipline, we think, is down to several factors. One is to do with the result of the market concentration that we saw through the M&A activity a few years ago, which has made the market much more concentrated. There are fewer carriers now participating on the trade. Not only that, then, that we've seen this formation of fewer but much bigger alliances on the main east-west trades, which has enabled carriers to develop much more streamlined capacity responses. Another driver was of the idle fleet earlier in the year was the high volume of retrofits to fit vessels with exhaust scrubbers in order for them to burn lower cost, high sulfur fuel. And we estimate that now about 20% of the fleet is fitted with these exhaust scrubbers. But we think the appetite for further retrofitting will recede, and is receding indeed, principally because the price differential between low and high sulfur fuel is much reduced, as is the cost of bunker fuel, generally speaking, as well. And we're not expecting any big increases now in bunker costs. Okay, so let's turn on now to look at equipment availability. So this has been quite a significant issue for many of you. And this chart is trying to illustrate some of that. So obviously the disruption to the trade has been a factor in that, made it quite difficult for carriers to reposition empty container equipment in major centres of cargo demand. But the other issue has been to do with the total fleet of shipping containers and the degree to which they have or have not kept pace with the growth in the vessel fleet. And this chart is illustrating that. So the blue bars here represent the total ocean-borne container equipment fleet, which is measured in millions of TEU. And then the grey bar shows you the total capacity of the container shipping fleet, measured also in TEU. The brown line is tracking the ratio between the two, what we call the operating ratio of the number of shipping containers relative to the capacity of the container vessel fleet. So where you see that ratio fall, that is an indicator that there is a lower ratio then of container equipment to vessel fleet capacity, and therefore that's an indicator of tight capacity conditions. And you can see that by looking at this line, the way that it started falling in 2019, where the growth in the equipment fleet was around 3%, and yet the growth in the vessel capacity was around 4%. And this year, the growth in the equipment fleet has stagnated, whereas the capacity of the shipping fleet has grown, as I said before, by 3%. And therefore, you've seen this reduction then in this ratio, and therefore tightening of availability conditions. But as you can see, we are forecasting then that the pace of container equipment fleet growth will rise, and with that then this operating ratio. So we think therefore that over the next few years that the availability issues will ease somewhat, although a lot depends on the level of trade disruption that we have going forward, particularly with regards to COVID-19. We think also another factor that will improve equipment availability is the increasing proportion of the fleet becoming smart or fitted with smart devices. And so a container becomes smart when it's fitted then with these smart devices that are able to track then the location of the container itself, but also to monitor the condition of the cargo inside that container. So by having that tracking availability, this should enable operators, carriers particularly, then to better manage the utilization of their assets. So this chart is then tracking our estimates of the current size of the container, of the smart container fleet, and our projections then for the growth of that. So at the moment then, we estimate that around 1 in 35 containers are fitted with smart devices. That represents about 2.7% of the fleet. This is the case at the end of 2019, and it's a result of a census that we carry out of all owners of container equipment each year. So we reckon that in 2019, the smart fleet grew by about 20%, but in 2020, it stagnated. We think the investment in smart devices stalled with COVID-19, but we are projecting that it will grow at a rapid rate over the next few years by around 22% a year to reach a total number of 2 million units, representing around 6.5% of the global fleet by the end of 2024. I think the other thing you can see looking here is that the proportion of the different segments of the fleet which are smart do vary considerably. So actually in the dry fleet, relatively few containers are fitted with smart devices, but in the reefer fleet, for example, a much larger proportion, we reckon around 23% at the end of 2019, were fitted with these smart devices in the reefer fleet. That's because of the monitoring of the cargo condition is particularly important in that commodity and reefer equipment type. So the rise of the smart fleet, we think, will provide further impetus for improvements in efficiency in which the fleet is utilized and therefore equipment availability. Okay, what does all this then mean for freight rate development? So this chart in front of you here is showing you the development of Drewry's East-West Container Freight Rate Index. This is a weighted average of spot rates across the main East-West trades. So the blue line is then tracking the development last year, and the yellow line is tracking the development this year. And you can see a tale of two completely different years and soaring average rate levels through the course then of this year. In fact, and the big drivers of this really has been the eastbound Trans-Pacific trade, where into the West Coast rates have been almost 3 times as high as they were this time last year, and into the US East Coast, the increase has been to double rates over the 12-month period. And on the Asia-Europe trade, rates have been up or almost doubled. And on the eastbound trade from Europe into Asia, rates have more than doubled over that period, which has really been quite unprecedented then in terms of rate development compared to previous years. We think the major influences then driving the recent amazing freight rate increases has been due to this higher level of concentration of carriers in the industry that I referred to a bit earlier, combined with much tighter capacity management discipline from the carriers. But I think also there's been an unexpectedly strong demand into North America and to some extent into Europe, partly on account of these replenished inventories that I referred to a bit earlier. Also a seasonal rush to bring cargo in before Chinese factories closed for the Golden Week earlier this month was a factor. And also another factor driving this jump in freight rates as well is the limited availability of empty shipping containers in Asia to move cargo to the main Northern Hemisphere markets. And that's been a factor as well in limiting capacity availability and therefore driving up freight rates. So in terms of the outlook for freight rate development, this chart is then showing you Drewry's estimate of average freight rate levels across global trades. That's all deep sea trades. These are averages across all different trade lanes, and that's shown by the brown line there. And the blue line is then following average rate levels across the main east-west trades. And the freight rate developments, clearly looking ahead, is very much tied to the outlook for the impact of COVID-19 and how that pandemic then develops. But also another big influence really is to what extent carriers continue to apply this very strong capacity discipline, bearing in mind that historically maintaining that discipline has proved quite elusive in the past, and with impacts then on our pricing discipline. So while recent M&A and market concentration has better enabled liner shipping to manage capacity and enforce commercial discipline, Drewry expects their grip on the market to slip post-peak season into 2021. Whilst we think that the discipline may maintain, we think that it'll be very hard for them to continue to balance this capacity and demand scenario as cargo demand then recedes, and also really as markets then start to normalize over the course of through next year and beyond. There is a risk also that that resolve waivers and one or more players break ranks to lower rates. I think the other thing to think about then is that even if that does not happen, there is the increasing risk to the carriers, at least, of more regulatory oversight to ensure that there is sufficient capacity available and to prevent the hiking of rates in the way that we have seen. So certainly bumper profits are leading to unwanted attention as far as the carriers are concerned from regulators. So the Chinese Ministry of Transport and the US Federal Maritime Commission have been making their views very clear and with warning shots on that front. So I think that that's something to look out for going ahead. So we estimate then that for this year, we think that average rate levels have risen by about 8% by the end of the year. This is across all different trade lanes and for both spot and contract markets. It doesn't sound like a huge amount compared to the whopping increases we've seen on particular lanes, but of course these are averages across all trades. And for next year, we are forecasting that rate levels will soften a bit. We think then that the spot market particularly will soften, sustaining current rate levels, as I've said, will be very, very difficult, very challenging indeed. But actually contract rates will rise, and we're already seeing that then in the contract negotiations taking place, particularly on the trade from Asia into Europe at the moment. Some quite notable rate increases going through there. So while spot rates are likely to ease through next year, we think contract rates will rise. Okay, if we now move on then to look at our forwarder benchmarking club and some of the benefits you can derive from that. This club has been running now for a couple of years. I'll give you some stats on the participation rates at the moment, but principally it's set up to do three things. It's set up to enable you to be able to buy capacity better by being able to compare your carrier buy rates with those obtained by other forwarders participating in the service. You can also use this as a pricing advisory tool to illustrate to you what the margin opportunity is between your carrier buy rate and the market rate by reference to the Drewry benchmarks. So obviously, the wider that differentiation, the wider your margin opportunity, depending on how you choose to price. And the third way is you can use it as a sales tool to demonstrate to your clients the competitiveness of the rates you're offering them, where these compare favorably with the Drewry benchmarks. So there's three ways you can use this. You can use it to buy better, to price better, and to sell better. The service now covers over 90 countries, 300 port pairs, 300 ports, but 7,000 port pair combinations. So a huge swathe of global trade covered here. Over 70 freight forwarders now participate in the scheme. They're moving collectively in excess of 10 million TEU and spending in excess of $11 billion a year. So what you receive is each month, currently the cycle is monthly, will be for the high volatility China-based trades, we'll be increasing that to weekly in the not too distant future. What you get each month is a benchmarking report that shows how on each individual lane, how your carrier buy rates compares with the average of all the other members, but also the lowest and the highest rates. So you can see the range, and also you can see the average for different sizes of forwarder, as well as where your rate ranks against all the other members. So you can identify on which lanes you perhaps need to do more work to get better rates. You also get a report showing the financial stability of different shipping lines in particular, and some of the big forwarders. If you're contracting with the lines, knowing their risk of going bust is pretty useful, particularly given that one big one went bust only a few years ago. And the service is completely free of charge. There is no cost to you whatsoever. So long as you join now, it may become chargeable in the near future. And if you join now, not only is it free of charge today, it remains free of charge for life. So whilst subscription charges will apply in the future to new members, when those come into force, they will not affect you if you join up now. This slide then just gives you an illustration of the detail you get within your benchmarking report. And what I've done is to blow up these column headings to illustrate to you below the information you'd receive. So under 1 is where you see the routing information and the equipment type. And under 2, you see a summary of your buy rate data by lane. And then to the right of that is the comparison against the benchmarks. That is the average for the members and the lowest and the highest rates. Then under 3, you can see the average rates for different sizes of forwarder. We categorize each forwarder by the global TEU they move, and we then allocate them to one of the 3 buckets of being a small, medium, or large forwarder. And finally, you can see where your rates rank relative to the other members providing rates on that particular lane. So very powerful information there. And of course, all data you share with us remains completely confidential, and we have an agreement that we both sign that obligates us to protect that confidentiality, to provide the service to you, and for you then to obligates you to provide your rate data to us each and every month. To remain a member, you need to be able to do that, and you simply have to complete either an Excel template summarizing your carrier buy rate data, or you can provide an extract from your rate management system, provided it is formatted in a way that fulfills the fields that we require to ensure that we know what is included in the rates that you provide to us. So in summary then the service is set up in order to enable you to buy capacity better, to price better by understanding the margin opportunity of your rates, and in order to sell better. And of course, everything remains completely confidential in terms of your particular rate data. Okay, so I'm just going to conclude now with some summary points, going back really onto my outlook for the shipping market, which is that we anticipate that global port throughput will rise by about 3% this year, and that the outlook for trade is very uncertain, but certainly we are seeing quite a strong recovery, which is very encouraging. That the market remains very heavily oversupplied with capacity, and we expect this to be the case for the foreseeable future, despite the fact that we expect the trade to grow at a faster pace than that of vessel capacity. Carrier capacity discipline has been quite unprecedented, but will be key going forward to maintaining freight rates at the levels that they are at the moment, if that is the case, or certainly in providing some kind of stability. We expect, though, that rate levels will fall off a bit next year. Equipment availability, which also has been a factor in driving up rate levels, we think will ease over the next few years. And also that will be assisted by the evolution of smart containers. And that we think that next year, whilst rate levels will fall, generally speaking, we expect, though, that it's spot rates that will see that fall, but contract rates, we think, will rise. So thank you very much for your time today. If you want any more information on our Forwarder Benchmarking Club, either please try to meet with me and my colleague Vishal over the next couple of days at the virtual meetings, or you can contact us using the email address shown at the bottom here, inquiries@drewry.co.uk. Thank you very much.